Great, thank you, Bill. Everybody, I usually do this as a lunch and learn in person. The COVID aspect has created this online, I call it impersonal concept, but I guess it works. It's our alternative that we have to deal with. This is the slide presentation that we normally present to folks during our lunch and learns. And it's meant for anybody that's thinking about investment property ownership to understand better how to look for property, how to finance it, and things to think about. You may already own property. And if you own property, this is going to be somewhat of a, yep, I already know that concept. But at the same time, there may be things you didn't think about. But also this will help explain how we offer financing for investment properties. So the next slide, if you can push that button, Maria, for me. Did not let in you, Maria? There you go. So this is contact information, as Bill mentioned. We're giving it to you here. It'll be in the slide presentation. It'll be with that you can access after the fact. But Michelle and I have really focused on investment property financing and the ownership education since both of us have been here. So that's our contact information that you'll have access for the future. And click again, Maria, please. So choosing a property. So the first thing when you're thinking about investment property, some of you may think, I don't think I can do this. I have no idea how to do it. So the first thing you would want to look at is say, how would I choose a property? So if you're thinking about investment property ownership, the first thing you want to do is sort of think about what kind of property would I potentially be interested in? And as we say here, a single family could be a single family house, a multifamily, which is a 1 to 4 family, or can be higher than that as well. It can go up to multiple units above 4. Mixed use, which would have a commercial aspect to it, like a retail downstairs and then residential upstairs, that type of a property. And then commercial property, which would have either an office or manufacturing type building, strip mall. Those are all the types of properties that you could look at. As far as when you go to do this, another thing to think about is how would you want to take ownership to a property if you did buy something? So there's lots of opportunities. You could do it individually, just in your name personally. You can also do what's called a limited liability company, which is basically you're creating a thing that has some protection for you, some liability protection. Then there's trusts, partnerships, sub-S corps. Those things I always send you to your trusted professionals and say, lawyer or accountant, explain to me what my options are and what my best scenario would be. So that's something that you would ask them when you went to do it. So you started by trying to determine what type of property you want to look at. Then you just have to think out loud how you would take ownership to the property. You can push the button, Maria. So where and how to look. There's lots of different ways and places to look for properties. You could find a broker to team up with. So you can say, hi, Mr. and Mrs. Broker, I'd like to look for properties. Here's the type of property I want. They would go looking into their MLS listings and whatnot and find you potential properties. You can go on the web. There are sites like loopnet.com. It's a great resource. You can just go in and look around there. You can drive around neighborhoods and areas and look for sale signs. Sometimes someone will say for sale by owner or whatever, or you'll see the for sale sign and you can call that broker. There's an interesting thing called a real estate investment group. So they're basically like real estate investors within market areas, and they're all over different states and areas. So like neighborhoods and regions, and you basically look them up online. You get into them. They have, a lot of them have breakfasts or they have lunches or dinners, and you basically go and you meet other people that are in this investment group. And they basically are people that either own properties or want to own properties, and they can be different aspects. They could be insurance agents, they could be brokers, they could be a housing court judge. Lots of different people get into these investment groups, and you can potentially get a property without having a broker, because these people might be like, hey, you know what, I'm in my 80s, I want to get out of real estate. And then you say, yeah, I'm actually looking to get into real estate. Now you just circumvented a broker. So now you could actually get something without having to pay a broker fee, potentially. There's also current real estate investors that are looking to get rid of stuff. So if you were having coffee at a coffee shop and somebody said, wow, I own a ton of real estate, but I want to get out. They could be sitting there and saying, okay, you know what? I'll sell you properties, sell you one a year, one every couple of months, whatever. Those are all possible scenarios. And then other places that you might find opportunities. Next. One of the first things that you're going to do when you're trying to find a property is you're going to try to analyze the cash flow of that property to figure out what investment potential it may or may not have. So when you're talking to somebody or a broker, or you're looking at a property, the best thing, if you can get it, is trying to get a tax schedule E, which on your taxes is where you'd put a piece of real estate that you'd have on your taxes. It would show the rents, it would show all the expenses. And this would be something you'd like to get from the seller, because you want to know, A, what are they reporting on their taxes to the IRS, which may or may not be 100% accurate, who knows, but at least it gives you an idea of what this property is doing on a tax basis. If the Schedule E is not available, you can gather other information to give you an idea of what the scenario might look like. So you could look to what's the rental income and expenses within that area. So if you know what the rents are in the area, you can say, okay, if it's $1,100 a month, that's great. If it's only charging $500 a month, that means they're underpricing their rents, things like that. So you'd want to gather whatever information you could as far as the rental income and the expenses. You can get insurance quotes or ideas of how much insurance might cost, utilities, things like that. We offer a sheet when we do our business loan application. It's called an investment property cash flow sheet. And basically it takes everything I just said. It's indirectly almost like a Schedule E, puts all of the rental information at the top, puts all the expenses in the middle, comes up with how much cash the property would generate for you. And then from that, you then determine how much could that support in debt. So the debt service that you'd have to pay every month or every year, it would be determining, does the property support that? Once you do that, you would have an analysis. So go ahead, Maria, that's fine. So to do that indirectly, this is just a hypothetical example, very fictitious numbers, but just gives you an idea. So you'd have the rental income. When we analyze a property, we take into account a vacancy factor, just in case. In case it's empty, there's going to be some economic loss to you, so we take it into account. You'd have an effective, your gross income potentially. Then we'd take away the operating expenses. So we'd deduct insurance, legal bills, repairs and maintenance, real estate taxes, utilities, all the basic expenses that you may or may not have. So in this case, in this hypothetical example, you'd have about $24,500 of cash that you could then say, okay, that's the cash that I'm going to have to be able to pay my debt. So based upon that number, go next, Maria. So based upon that number, we just did a hypothetical thing of saying, okay, if you had a loan, proposed loan, and it was going to require $15,12 a month. I don't even remember what we used for a number for that, but it's a hypothetical. So $15,12 a month in debt service, principal and interest, would give you, give or take, $18,144 for the year. So in that scenario, you're making $24,500 of cash. You'd have to pay out your debt of $18,144. So this property, as a hypothetical, would actually make you $6,000 of extra income a year. The property itself, we like properties to debt service coverage by 1.2 times on their own, meaning their rents, their expenses. We like them to cover their debt service by 1.2 times. We do approve stuff based upon a global basis, meaning we take into account all of your income, personal and the business, but we like the property to actually be covering itself, because you want the property to be making you money, not have you losing money on it and you're working for it. So in this hypothetical example, the debt service coverage was proposed 1.35 times. That would create a continued conversation to be able to continue looking at financing for the property. If this was less than that, it still could create a conversation, but it might be, are the rents considerably under market? Is it not charging the rents that it could have? And then at that point, you could say, okay, if I buy the property, I would increase the rents, then the property might work. So that's just, this is more just a conversation piece. Next. So as far as if you found a property, so you found a type of property, you've got a broker involved or whatever, you've got some idea of what the cash flow looks like on it, and you've decided to either make an offer or you say you want to continue to look at this further, you would have a business loan application you would submit to us. That application would be the application itself, which would say how much you're trying to borrow, what exactly you're borrowing it for, et cetera. So you'd have like the property, the investment property, the cash flow, things like that. Personal financial statement gives us a snapshot of you individually, of what you look like on paper as far as assets. So you'd have your cash, you'd have your liabilities, and we can see what you look like as a net worth basis. The debt summary sheet shows us overall what kind of other debt you have. Environmental questionnaire. What information can you give us about the property? Do you know of any possible hazards, underground tanks, asbestos siding, lead paint, things like that? That's just an environmental questionnaire. Some things you'll know, some things you may not, but at least gives us a starting point to consider the property. The form 4506C is a IRS tax form, just gets us the transcripts of the taxes that you filed with the IRS. Hopefully the stuff that you give us in hard copy or email that you give us saying, here's my 2019, 2020 taxes. Those taxes should jibe with what you actually filed with the IRS. And that's what the 4506C verifies for us. The rent rolls, a rent roll on the property. So you would basically be an estimate of where it is today, what the rents are per unit. And then you could also, in some cases, as we mentioned, if it's below market, you would put in, it's right now below market, but I'm going to be increasing the rents to X to get it within market. And that's what that rent roll sheet would show us. And then a current summary of other real estate owned is going to give me a picture of what other real estate investment properties you own and how they are working. Are they making money or losing money, et cetera? And then in addition to these application items, we would ask for 2 or 3 years of complete personal tax returns, as well as any affiliated real estate LLCs or anything else you have, business entities that are not fully reflected on your personal returns. We'd ask for those as well. So not overly encumbered, but it's a lot of information that we get, not too hard to fill out, but and any questions you ever have on that application, you just call us and we help you, we talk you through it. Next. So the first thing, once you found a property, and again, this may come before you have the application submitted to me, but in general, the purchase and sale agreement, you want to team up with what I call trusted professionals. So in this case, a real estate attorney would be used to create a purchase and sale agreement on the property. You always want to make sure that the purchase and sale includes things like a professional inspection of the property, as well as contingency for bank or mortgage financing, because you want to make sure that you have the ability to look at the property. As an example, I had a commercial building. It was a brick looking building. And when they went in and did an inspection, they found termites all over the foundation, like the lower section of the building. I never would have thought that, but they found that and they ended up walking away from that property. That's a great example of where an inspection could protect you. Even things like bad roofs, bad cellars, bad whatever. There are things that an inspector could find that you may or may not see. And to be able to use the ability, if you can't get bank finance and you want that to be your out so that you get your deposit back. If lead paint's involved in the property, that's another thing to be at least cautious about. If there's blatant lead issues as far as like mantles on windowsills and things that are exposed, cracking, and we think there's lead paint, those are things to think about, because when you take possession of a property, you inherit the liability associated with that lead. If somebody's been gnawing on that windowsill and the child has lead poisoning, when you take possession of the property, could be held liable for that. And that's something you don't want to be dealing with. And if you ignore the idea of watching or looking for the lead stuff, I say beware, because it could cost anywhere from $10,000 to $15,000 per 1,000 square feet of space to remediate that problem if it's in fact there. There are lots of ways potentially around that, like encapsulating, like vinyl siding outside. If it's a lead vinyl siding or a lead siding of some sort, or asbestos siding, you can encapsulate it. But like windows, windowsills, inside paints, things like that, door frames, those are all things to at least just have an idea of, because like certain states have different sort of mandates as far as the lead goes, but you're always still liable in case a child or something gets lead poisoning from it. So it's something to take into consideration. If you can get a lead paint cert from a seller, that's a good thing. Depending upon when the property was built and whether they used lead paint or not, that's something else just to know or have a handle on. And when you're looking around the property, just look for these things, because we have run into people that, like asbestos siding. You have a choice. You can either take it off, take it down completely, which you need to have a fully licensed asbestos remediation company do it. And they have documentation and everything else. They have to encapsulate the property and do it. Or you could potentially just put vinyl siding over it to protect it. But those are all things you want to think about. Another thing to look at is, are the real estate taxes current? Are there any municipal liens hanging out there for the water and the sewer? If there's a septic, do they have a Title V? You're going to have a Title V for that septic system. You want to make sure it passes. So those are all just other things to look at just to make sure it's clean. If you went to close the loan, the real estate taxes, we would check to make sure they are in fact current, as well as the municipal liens. But if you were, let's say, buying a property at an auction and you said, I'm going to buy it for cash and then I'll get financing later, those types of things you'd want to look at first to make sure what are the taxes that are behind you, because most auctions will sell things as is, where is, with whatever liens are out there. So you need to know, are there taxes due? If there's $100,000 of taxes due when you buy the property, you now owe those taxes. Same thing with the liens on all the stuff to have things turned on. If there's a lien out there, you're going to pay that first. So that's just something to keep in mind. And in the Title V, if the septic is bad, it could cost you anywhere from $25,000 to $45,000, $50,000 to replace a septic. So you want to know that going in, is that in fact the problem or not? Next. As far as when you go to finance a property, there is an appraisal requirement. So we would engage the appraisal. You would not engage it because it has to be a disinterested third party. If you had it engaged before you came to me, I cannot use that appraisal. Whether it was legitimately an arm's length appraiser or not, it could be a friend, relative, whatever, but we have to engage the appraisal. We have to do it. So don't engage it yourself, because whatever you spend for that, if it's $3,000, you're gonna have to spend it again because we're gonna have to engage it. And when we do financing, we base our numbers. We typically do a maximum loan to value of 80%. That's based upon the lower of cost or fair market value. So if you're buying the property for $100,000 and it appraised at 160, I'm only basing it on the $100,000 that you purchased the property at. And that's the number I would use. At that point, the extra money is just equity you got because you bought it, but my number is based upon the lesser of purchase or fair market value. Next. Typical loan structure, how we typically put together a financing package. We do a 15-year term of the note. So that means the note itself is written for a 15-year term. Your repayment is based upon a 25-year amortization. So your actual repayment amount, your principal and interest, is based upon 25 years. So where the note goes 15, the amortization is 25. At the end of 15, you will have a balloon payment due, at which point we would have to talk at that point and try to refinance it. To do that, a lot of people have set up these notes to do a 15-year note, 25-year amortization. They overpay the principal to have the note basically be paid off within the 15 years, and then use the property as if it was an annuity. So it was just be paying them as almost just clear cash at that point. We propose you can fix the interest rate in this scenario for either 5, 7, or 10 years. And basically what we do is we would fix it for one of those periods. We oftentimes basically talk or advise, it's your choice, but we oftentimes set it up to be a 10 years fixed rate, takes out your interest rate risk for 10 years. And at that point, 10 years comes, now we fix the rate for another 5 years. And that would be based upon a Federal Home Loan Bank plus a spread. And that would get us to the 15-year mark. And then at that point, then you talk about refinancing it. But right now, the interest rate risk is something that a lot of our borrowers, they really enjoy that 10 years. Most places will go out 5 or 7 years. Not a lot of places go 10. But again, you have the option to go 5 or 7. It might be a little bit less in interest rate, but you'd have the interest rate risk. If in 5 years, the rates really double, tripled, that could really hurt you and the property wouldn't work. Any individual that owns more than 20% of the property, or the LLC or whatever entity is owning this property, any owner of more than 20% or more, they have to personally guarantee the loan. We would take a first mortgage, an assignment of leases and rents on the property being financed. And then again, as I mentioned earlier, the minimum debt service we look at on a global basis is 1.2, but we also want the property itself, if possible, to actually have the same debt service coverage ratio of 1.2 as well, because we want that property to be making you money, not losing you money. Next. Some good reference sites that I've utilized and I've had investors utilize. MrLandlord.com. It's something I stumbled on years ago, and I think it's one of the oldest landlord websites that's out there. It's a great resource for anybody that's an owner of a property. It has anything from examples of leases and contracts, and they have chats, and they talk about the like scenarios of situations that have happened to other landlords. And they give you advice on things like, well, this is what happened to me, and this is how I resolved it. It's a great resource for that. That's something you can look at. And then also the real estate investment associations, real estate clubs, all these other ones that we've listed here. Those are other good resources just to try to get information. Next. So as part of this presentation, there are no stupid questions. Anybody that's done this for years, I'm still learning 30-something years into this game. Anybody that owns property, I'm sure you've run into new situations, different situations. So there's no stupid questions. If you've never done this, There's absolutely no stupid questions, again, because you have no idea what to do because you've never done it. If you think that an investment property ownership is something in your future, that's fantastic. You can ask all the questions now. You can learn all the basics without actually doing it. I oftentimes tell them, look at a property and do it on a hypothetical basis. So basically take the information we give you here. You can give the investment property cash flow sheet, things like that. You can literally sit on the side of a street while you're looking at the property, quickly put in some of these numbers and say, wow, that property cash flows like 1.6 times. Well, I think I'll put an offer in on it. Or you could look at that thing and say, it doesn't even cash flow 0.5 times. I'm not even going to make an offer on that because the property doesn't work. So it's a great way to do hypothetical, cost you no money, just gives you examples. You can look at stuff online. You can have conversations with brokers. You can tell the broker, I'm interested potentially, don't know how or when, keep me in mind. So you can just have those conversations, practice looking at properties out there just to see how they would work. And the more you do it, the quicker and easier it becomes. If you found a property that really made sense, you can immediately say, yep, I'm going to make an offer, or no, I won't, based upon your comfort level and your experience of looking at properties. The more times you look at them, the quicker you can assess the profitability and the cash flow capability. Next. So in the beginning, we gave you this information. And again, after this, I know, as Bill said, it's a lot of information. It's a lot to digest in a short period of time, but it's good information. Feel free at any time to contact Michelle or I. And if you send an email, you're more than welcome. Send it to one of us, send it to both of us, whatever. And one of us will get back to you and help. Again, we have no problem talking to anybody about anything. Every situation could be similar or could be totally different. And we'll give you ideas of our thoughts and concerns and go from there.